Trading Chaos by Bill Williams. Profittunity.com. This is the book I love. This is what we have based everything on. The lesson is here, page number 191. Do you really enjoy the act of trading? Or do you suffer from fear and greed every minute you are in the market? If you suffer, it is because you don't understand either the market and or yourself. It's just full of amazing information. I've read it so many times and I still read it from time to time. It's a really good book. The concept is fantastic. I have found that the greatest and most successful traders find their main reward in the activity of trading itself, being in the zone. World-class traders see the market itself as a support mechanism. Amateurs and or less successful traders see the market as threatening. And that is what it is. Anyway, so let's have a quick look at the market today. We are going to check 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 markets. That's it. So we're going to go through the hourly and then the 15. It's going to be mostly coulda, woulda, shoulda stuff in this because I wasn't trading this, but I've already done my trade, as you have probably seen in my other video where I made a $500 risk and it hit $1,000 and $1,010 profit target, while I was trying to teach or answer Edward's question in his that he asked in the chat room and in the forum. So I hope I was able to answer his question, and at the same time I took a cherry trade. Anyway, so this is Australian dollar. We can see it's going up, and this is what we need to look at. Like, for example, we were on Friday and the market is like so, the open gator, if Edward is watching. Inside of this, let's put a line there. Where's my triangle? There's going to be a triangle somewhere. Yeah, it appears here now. See this triangle? If you draw a line there, wherever this triangle is, when you change the time frame, that's where it's going to go. So when I go to the M15, it's going to go to this time frame because that triangle is here. And you can actually fix chart position. It usually can be dragged from this position here. It's usually here. So you go there and drag it and bring it here. And it only works with when this button, scroll the chart to the end on tick incoming. So it's automatic scroll. When that is off, only then that's available. So if I click that on, it disappears. So if I click that off, it comes. So this is where I will go. So if I go to the daily chart, it's going to be here. If I go to the M15, that's where it is. This is where it is. Hold on, let's do it again. Here and here. So we know exactly what M15 would have been like. So every pair is different. And by difference, I mean that when you see a full screen chart like this, so the number of pips from the bottom, which is the lowest peak on that chart. So MT4 is designed in a way that right now it will zoom in, it will look at the last candles of displayed candles. So at the moment we have 230 candles. Then it would look at the highest spot between that range and the lowest point, and it will zoom into that. So if that market moves about 100 pips on average between those 200 candles, then that it will show it that way around 100. So if there's a market that has lower volume and lower movement, so if in every 200 to 220 candle it only moves about 50, then it most probably will catch the 50 pips in between. And that means that every market this way is different. Every market has different volatility. So if you go to the DAX chart, it moves in a day. This is a day, right? From here to here. So let's see on Australian dollar, it's moved about 64 pips. This day it's moved about 57 pips. On a DAX, it could move 57 in an hour, sometime in a few minutes. And because it moves around 150 to 200 a day, so when you look at 2 days of price going up and you count that from up to bottom, instead of 100, as it shows here, you'd see 300-400 points move. And so those charts we call as dense, whereas other charts are less dense. And we need to understand this. So anyway, and the reason I'm saying that is because the denser your chart is, see, the denser your chart is, and by dense I mean these numbers on the vertical axis, the vertical scale where the price is. So on the horizontal scale, the x-axis is the time. So that's a constant. It keeps ticking at fixed intervals. But on the vertical scale, that's the data coming from, this is the delta of price, change of price per unit of time. So if it changes more, then it will go up and down more, and there will be more numbers between the top and the bottom. And those charts are considered dense. So I don't think Australian dollar on the M15 time frame is as dense as DAX is. It is not as dense as pound yen or the pound dollar. It could be probably as dense as euro dollar. Let's look at euro dollar. So if you look at the euro dollar M15 chart. So on Friday there was quite a lot of movement, and that movement was just about 60 pips. Today it's moved around 30 pips. So let's do analysis. Now, this is one of my favorite buttons. You can use it. You can use keyboard shortcut, which is Alt R. I always use it, and I've got it, and I've got this shortcut placed into my mouse. I don't know if you can see it. So it's got a few buttons here and there. So I have, these are reprogrammable buttons. So I have 2 buttons for Control Tab and Control Shift Tab, which does this. So the trick is to click on this and then go to the first chart displayed here. Should be this. And it's going to be first one over here. You click on that and enlarge it. And then when I do Control Tab on the keyboard, and because I have reprogrammed my mouse buttons, these ones, see, this is Control Tab, so it goes forward, and this is Control Shift Tab, so it goes backward. So this allows me to go forward and backward quickly. If you're on a laptop, you'll just use Control Tab or Control Shift Tab to go forward and backward. So I have Australian dollar. What did it do today? Now, let's go to the hourly chart. Now, if I looked at this chart in the morning, I would say, okay, it's going towards the purple in wave 4. And this, to further understand it, I would quickly go to the daily chart. And I'll say, okay, it's some kind of a PC happening. Maybe it comes down. And then overnight, I have this huge candle, so some news must have happened. And then it pulls back up. I'm very convinced that if I go to the M5 chart, I'll probably find a very good setup. So this is that move that happened overnight and then comes back up. Not a very exciting setup on the M5. What did we see on M15? On M15, we had a pretty good setup 1 or a setup 2 here. So if I was watching it closely, I could have taken this at Frankfurt Open for a 12 pip stop loss and trailed it and got stopped out on box trail for double of the profit. So let's do some more coulda, woulda, shouldas. New Zealand dollar looks like it had one of those setups. This is half a setup one. I've always been thinking about what should I call this. Is this a setup 2? Is it a setup 1? It actually really is a setup 1.5 because it's between setup 2 and setup 1. So I'm very close to deciding of probably calling it the setup 1A or setup 1.5 because you have the 3, you have the 4, but you don't have the fresh cross of zero line. But you don't have divergence either. The purple is correct. There is dot. Gator is kind of asleep, but not totally asleep. Can't really call it a setup 2 because it's not a pink dot. But we can see that there's a 3 and there's a 5. Now the other trick for this is that a setup 1 consists of a minimum of 4 T candles or bars on AO and a maximum of 96. So you count it from somewhere arbitrarily around where you think is wave 4, where the signal is, and count it from here back to the that this peak corresponds to this peak. From here to here. Where's my drawing tool? This bit. So AO is about 4 to 5 bars lagging. So this peak corresponds to this peak. See around here, this peak corresponds to this peak, the hidden divergence, and this peak corresponds to this one. Here, this one corresponds to this one, and this divergence corresponds to this one. And so there's this divergence between this peak and this peak. Let's change the color. To blue. So that's one divergence between these peaks. And this divergence confirms wave 5. So if you understand how to count Elliott wave in 10 seconds concept, you don't always need a cross of zero line if you understood it. Because if this is the peak of AO and this is the valley that's created between the pullback and gator sleeping, then the next wave obviously will be a wave 5 if it diverges. It's all about divergence. So if price creates a new peak, but AO does not within the last 100 candles, then that is a wave 3. So let me take the drawing off. So now we were talking about this. If I count this, this is 60 candles. And that means that this is a valid possible setup 1. If I wanted to have the accurate number of candles or bigger number of candles to get a more accurate picture, I could split this chart a bit further. Now M10 would have been best, because if I go to M15, then this would change into, because it's 60 candles, it's going to change into 180, which is a bit too much. So then in wave 4, price is going to go, AO is going to go up and down around the zero line, and purple will mingle with price, and that would not create a setup 1. So let me show you what I mean. In fact, it has created a pretty good setup 1. So on this occasion, if you can see, it's 175 candles, which is about 35 more than what we want, but it's created a lovely 3 down and a 4 up and a setup 1. So if you entered here and your stop loss was there, because that is the peak of wave 4, and then it bounces against the peak of wave 3 here, and if you stayed in, again, let me draw this again for you. This is wave 3. This peak corresponds to this. This one corresponds to this. So this was the 3. This is the divergence of the 3. So this is the 3. This is the 5 of the 3. So that's the 3 down. This is wave 4. And this is wave 5 because it has diverged And another way of looking at it, and another confirmation, would be to go and put the target zone 1. So if we put the target zone, there's a weekend in between. So when you have a weekend in between and you're trying to draw the target zone 1 study, this leg goes all the way somewhere, disappears. That's the MT4 thing. So there you go. That's where target zone 1 comes. And I didn't know this was going to happen. Just look at it. Just look at it. It's just spot on. Comes here, and that's where wave 5 ends. And I mean, what more should I say? And then for the support and resistance people and them, the market also throws something for them as well. It's not that it doesn't work. I mean, that's what it is. This is the way the market, this is the structure of the market. Look at it. Where does it bounce? Around the previous levels. Around the previous levels. This level, and this level, and this level. So if you were trading from here, your obvious first target was this, to see what it does, because of these levels, right? These levels. And then when it clears that, then your obvious target was these levels. And that's what it did. But if you trade with our concept of trading chaos, you don't have to look at the levels and stuff, because you have a different dimension, a different perspective of measuring the market, which is target zone 1. So without even looking at these support and resistance and stuff, we knew our target zone 1 was there. We had to get out. We had to target there. So if we target it here, and then the price action guy or the support resistance person would look, they would say, oh yeah, that's where the support was. So good exit. Right. Let's go to the next chart. Using my button, we go to dollar CAD. So dollar CAD had a very, very strong move yesterday, and when you have the rubber band principle, you have a very, very tall box. A very tall box, a very steep angle. And that usually is not followed by a good setup one. Even then, if you took a trade here and it went up, you paid a rent, that's fine. 33% of the trades are going to be like that. Right. Let's just look at H1 as well. So as you can see, there were news on Friday, and this is what happened. It's 2 days. So as you can see, it's moved too fast away from Gator. And when something like this happens, I'm not usually looking for the famous setup on the day after. Swizzy on the hourly is not really moving. You know, look at the Gator when you have these humps and stuff going on. Not really interested. We need to have clear markets, and I will show you in a bit what clear markets are. Euro dollar, the H1 Gator was sleeping, right? So I don't need to look at M15 for this market. Euro Australian dollar, nothing really interesting. Sideways on the dailies. On the hourly, it wasn't really exciting, and then it went the opposite way anyway. Now this is a chart where you have some volatility. Now look at it. This is a dense chart. Check the distance between the highest point of this chart and the lowest, and that is about 500 pips. So when a market does around, you know, this many pips in a day, those markets can be on that day traded on the M1 chart. So if I have no doubt, if I go to the M1 chart and check yesterday's trades, which is Friday, there's going to be fantastic setup ones. So Friday will be the 11th of October. There you go. Take it there. Here we go. Now, right. So I think there was some news earlier, so it went down, probably hitting some stops losses and stuff, and that's where the buy orders activated themselves. Went up, creates a peak, comes back to the zero line, creates a fantastic setup one, bang, goes up. I think I talked about this in the other video as well. And then after that, another setup one. Bang, it goes up. And another setup one. So if a market is doing anything less than 100 pips a day on average, actually less than 70, don't bother with it on M1. But if it does more than 100, more than 150 and higher than that, it's a good candidate for M1. Because on M1 you need something, you need on average for the market to move around, you know, so in an hour there will be 60 candles, and in 2 hours you'd have 120 candles. Within those 220 candles you want to trap at least 1 or 2 trades, and so you needed to move between 10 to 15 pips in your favor, and you would need around 50 to 60 pips for the wave 3 to move, and then those 20 to 30 pips of price pulling back, and then another 20 to 30 going down in between, where you will trap those 10 to 15 pips for yourself. So that's how the setup one works. So if you look at this market, it's moved 40 here, and then it did not pull back that much, and then it went back down, so you have another 10, 15. So this is the you know, today's market, like pre-London Open. So obviously volatility was not that high. Around here though, this is the Frankfurt Open. So you have a 3, and then you have a, or maybe this was a wave 1 and 2. Now we know because this is 3. So you have price creating a new peak and then cross of 0 line, and then you have a nice lovely setup 1. Stop loss is only 10. It goes, closes on green. You either hit 2R for 20 pips, or you probably had 30 pips from this, or even 35, trailing the candle here. So if the market, if that pair is moving and you are monitoring on the hourly, you might be able to go down to M1 and trade it, and only do it when you see something like this. So when you see the market is doing this stuff and it's high volatility, then you can do it. And as you can see, even today we got setups on this because pound is still in high volatility. If you look at it, the range of today is still 136. But if you look at the Australian dollar, which is only about 50 pips, if you go to the M1 chart, you won't really see lovely setups on it. And even if visually they are lovely, they might not have enough pips in it, because if look at this bid and ask. See, if the market doesn't move more than 100 pips in a day, and if it's a 50, then the spread becomes a bigger proportion of it, of the move. So as you can see, this is quite, you know, noisy, what we call. This is quite a lot of noise. So you can see a 3, 4, 5. This is where AO kind of lies. It doesn't really lie to you. It's telling you it's a 3, 4, 5 going on, but the distance between the peaks is so narrow that it's not worth it. So look at it. This is wave 5. The wave 5 is only 6 pips. And why is it 6 pips? Because the wave 3 itself is about 11 pips. So it's perfect. It's perfect from that point of view. But because your spread is 1, and then you have to give a 1 pip buffer, so that's 3 is taken out. So 3 is your, you know, your expense, and you're only making 6. That doesn't make sense. So because if 3 pips is always your expense because of the buffer, one below, 1 above, and the spread, you need to make at least 10 pips to make it your worth. That's some of the points hit on this. And I've come to about 25 minutes on this, so I think I'm going to stop it here. And I hope there was something for you to learn. If you would like to learn our 3 strategies of trading the market, incorporating the concept of the 10-second Elliott wave. So everything's built on our concept of 10-second Elliott wave. The link is down below in the video. Download your free PDF, read it. If you subscribe to the email, you probably will get a little gift. We'll send you another free AIMS AO. Not this one, the one that doesn't have numbers, but it's better than AO because it has 4 colors. And so that will be a free gift to you. And this book is very dear to me. Everything that we do is based on that. We have developed 3 strategies that incorporates this. It's built on this foundation of this concept. It's the setup one to start you at stage 1, and then at stage 2 you go to the hunt strategy, which I touched upon in my last video, which was released October 15th, 9 o'clock. I'll link that below as well. And then when you go to the stage 3, that's where you develop your own style. And we also introduce the fruit method to you, which is the reversal method, and that completes the AIMS setup. So then you will have the proper hunt setup where you would be able to take the breakout into wave 3. In between wave 3 you'll be able to trade the when it does a wave 4 inside the 3. That's the hunt signal, somewhere around here. Let me actually catch one. Let's see if I have the hunt. So as you can see, like, this is wave 3. Not a very good example. Let me find something else. See, this could have been like, this is a wave 3, right? And in between there is the consolidation going on, and we have the hunt signals popping up. Actually, I'll use this one as an example, and I used in my other video as well. So this is the Monarch hunt signal. Monarch because this is the first cross of zero line, the first darkening of AO, and this is the first breakout of the range. So as you can see, the market was range bound. We wait for the breakout, and then we wait for that pullback, and most probably around where you have marked your range, when it bounces against that, the gators open, AOS cross the zero line, and this is where your hunt seed signal appears. So if I go down using my arrow trick, this would be a setup 1 on a certain lower time frame. Let's look on M15 first. And as you can see, it was almost a setup 1, a 3 up and a 4 down. On M5 probably would be even better. Here it is. So you have a 3 up, sideways, a 4, and then it goes up. So that's the hunt signal. But instead of going all the way to M15 and 5, if you're comfortable on the hourly, you would have the hunt signal here. You take a pending order above, stop loss here, and then let it run, and you made 100 pips. So that's the hunt signal that goes inside. And then when price comes back to wave 4, around here we have the apple signal that allows you to get into the wave 5 before anyone else. So even before a setup 1 signal appears, you have an apple signal that gets you into the trade before that. And especially when the wave 4, and especially when wave 4 is something like this, which is a correction down, a zigzag down instead of the sideways, then the apple signal is very, very powerful, and then the box becomes the add-on to it. And then when you take that trade, it finishes at target zone 1 where wave 5 ends, and that's where the fruit signal comes into play, where you start trading the reversal. So this is a complete methodology, but you start with setup 1 at stage 1, and then do your progression from there. A lot of the people don't do it, and that's why they don't make money. But if they do take the challenge, the 3-month challenge, they do the stage 1, stage 2, go to about 400 trades, they learn so much about the market, but a lot more about themselves, who they are and how they should be trading, and what type of markets and what kind of strategies they should be doing. So this strategy has covered all forms of market, a bit of everything, but the base of it is the 10-second to Elliott Wave concept. Click on the link below. Please subscribe, like, comment, and follow the link so you can understand our core concept, that is the 10-second to Elliott Wave. I cannot talk to people, I cannot make them understand until and unless they take the effort to actually download that short PDF book that I wrote years and years ago, and I will not change it because it still works. Once they read that, then I can talk to them, because then everything that I say makes sense to them. See you.
Thank you for watching. I hope you liked this video, and if yes, please hit the like button. Do you have any questions or ideas for upcoming videos? Then leave a comment. Also subscribe to the channel and hit the bell icon so that you never miss any future videos. See